Western central banks, namely the Fed and ECB, are deep into tightening cycle. However, the effects of monetary restriction are proving to be not enough to bring inflation in a timely manner to its 2% target. That is why, according to the research by Bridgewater Associates, we may see a second wave of inflation, which will lead to a second round of interest rate hikes. In the next few minutes, you will learn why we will probably see a second wave of inflation and how much further will Fed have to hike its interest rates to bring it down sustainably to its target. This may have large implications for stocks and other risky assets. Persistent inflation is always and everywhere a monetary phenomenon, in a sense that it can be caused only by growing money supply faster than the productivity of economy. That is what Milton Friedman, the American economist and Nobel Prize winner, said about inflation. Undoubtedly, this also applies to the situation today, when Western economies are running too hot due to a huge amount of excess liquidity that governments and central banks pumped into the economies during the pandemic. But it seems that central banks are not willing to tighten the monetary policy to such an extent that would force inflation out of the system. Although both the Fed and ECB are not yet done with their interest rate hikes, the willingness to further tighten the monetary policy is significantly waning, which is why the Fed paused before their last interest rate hike and will probably pause again in September. Interest rates are undoubtedly already slowing the economy. However, the question arises whether central banks are doing enough to bring inflation down sustainably. At Bridgewater, they believe that the conditions required for 2% sustained inflation are far from being achieved. In fact, the data shows that in the last few months, we have been moving further away from these conditions. What are those conditions, you may ask? Historically, a stable 2% inflation requires a neutral rate of nominal GDP growth. Also, it is important that wage growth is not excessive, as that would significantly stimulate the consumer spending. In order to achieve neutral rate of nominal spending and wage growth, it is necessary that unemployment rises. The only way companies would lay off their employees is if their profits are falling. All those variables are correlated and dependent on each other, which is why it is enough to change one or a couple of them to change them all. And that is what higher interest rates are supposed to achieve. There are 4 specific conditions that Bridgewater Chief Investment Officer Bob Prince suggests are required to achieve a sustained 2% inflation growth. Current data show that US wage growth is far above 2.5% rate. See the purple point on the chart. In fact, in last months, it has reaccelerated from 4.3% to 4.5%, moving us further away from the required condition. Hand in hand, the neutral spending growth rate, or GDP growth rate, is currently sitting very high at approximately 6%, although it does trend down. The required neutral level of nominal spending is somewhere in between 3 to 5%. Corporate profits are already to some extent falling. According to the FactSet, S&P 500 constituents have reported a 7% decrease year-over-year in profits in second quarter 2023. Data shows that you need approximately 20% decline in profits to induce layoffs that would lead to 2% increase in unemployment rate to achieve a 2% inflation target. And again, as you can see on the chart, we are moving further away from the required drop in profits, which is the purple point on the chart, and we are currently sitting near the record minimum of 3.8 unemployment rate, and it does not seem that it's gonna move upwards anytime soon. The amount of new borrowing seems to be rebounding as well, after a huge slump in the last year or so. This is not what we need, and moreover, the rate of layoffs among companies has decreased in recent months, moving us further away from increasing unemployment. The red line on the chart stands for layoffs rate, and it is inverted. In other words, if it goes up, the layoffs rate goes down. It means less people are being laid off. It is inverted to show the strong relationship between wage growth and layoffs rate. Whereas you have strong wage growth currently, you have a low amount of layoffs, which makes sense. The stronger the wage growth, the more the labor demand, the less the companies are laying off. So, is there going to be a second wave of inflation? Let us first hear what Jamie Dimon, the CEO of JPMorgan Chase, had to say about it approximately 1 month ago in an interview.
How do you see inflation evolving?
I think there's a higher chance than others think that inflation won't come down low enough. We had more fiscal spending than the world has ever seen in the shortest time period the world's ever seen it. So, and that's still in the system. You had huge QE, and those are gone. So you might have the 5 or 10-year rates ticking up. So, again, I think that might go to 4.5%, 5%, 6%. People should be prepared for that.
Mr. Dimon is truly a remarkable and influential person, so there's some weight to his words. What he's actually saying is that we are gonna see a prolonged period of inflation, and that we might see long-term treasury yields go up to 5 or even 6%. Of course, if that happens, that is bad for both the economy and risky assets such as stocks. I mean, think about it. Would you rather have 6% annually risk-free or invest in stock markets that are already highly priced and carry much higher risks? The institutional investors are clearly going for the first choice. That is, they will put their money in the money market to earn the risk-free rate. And if it is at 6%, it's gonna be significantly more interesting than anything else. The way I see it, there are essentially 3 scenarios going ahead. First, the hot economy scenario. If the economic rebound will continue and interest rates will fail to weaken consumers and firms, it's highly probable the United States will go through a second wave of inflation. It may not be as high as the first wave, but it will move us further away from the 2% target by central bank. This will also lead to a second round of monetary tightening, where interest rates may rise up to 6%, if not more. This will also increase the strain on the economy, making hard landing more likely and making stocks very unattractive as compared to bonds. This would be your Jamie Dimon scenario. Second is the economic moderation scenario. It is possible and perhaps even probable that the current economic regeneration is just a temporary thing. It may be caused by a recent inflow of liquidity by US government and rush summer of entertainment and tours. Morgan Stanley economist Sarah Wolf thinks the combination of Barbie, Oppenheimer, Taylor Swift and Beyoncé may have significantly contributed to the economic activity this summer. Some experts even suggest that Taylor Swift has caused the recent uptick in the inflation. I do not necessarily agree with that one, because I think the recent uptick in inflation was caused mainly by the statistical base effects. It is those statistical effects that will serve as a headwind for CPI headline inflation to go down for the rest of the year and well into the next year. Also, core inflation will be affected by this statistical effect starting September, which means it will probably not go significantly down starting September and well into the next year. The current economic renaissance was probably also supported by growing optimism among consumers and firms, and by growing stock markets via wealth effect. However, in this second scenario, I would expect this economic uptick to wear off going into the winter. Also remember that starting October, the student payments are being restarted after 3 years long moratorium. This, in combination with falling excess savings, could dent consumer confidence and weaken the spending in the next months. I would expect the Fed in this scenario to increase rates at least one more time before pausing, and that increase will probably not be in September but in November FOMC meeting. Third scenario is the rapid economic deterioration. In this scenario, the economic rebound will quickly wane off. This, compounded with a weakening consumer and increasing strain of interest rates, could accelerate profit losses for the US companies, which would be followed by growth in unemployment. However, this scenario seems to be less likely given the moat that was created by US government and the Fed for US economy by printing an unprecedented amount of money. This would also mean that there would be no more interest rate hikes and that we are already in the pause period. In conclusion, none of the scenarios include falling interest rates anytime soon. Also, I think a recession is a likely outcome in each of the scenarios. I personally assign highest probability of happening to the second scenario, the moderating economy. 35% probability I would assign to Jamie Dimon's hot economy, and 15% probability to the last scenario, the rapid deterioration of the economy. Now remember this, whenever in the United States unemployment rose at least 1%, it led to two things. First, it led to economic recession, and secondly, via persistent momentum, it led to growth in unemployment of at least another 1%. It is important that you watch the labor markets because that is what truly controls the behavior of the Fed. Also, it is good to know that oftentimes the conclusions of US markets could be extrapolated to European markets. That is because these two regions are strongly integrated and they oftentimes behave in a similar manner. Therefore, this analysis would, with a grain of salt, also apply to the folks investing in the European markets. In any case, the next evolution in monetary policy and economy will probably be unfavorable towards the risky assets. Not even treasury bonds are attractive as of yet, given the possibility of the second round of interest rate hikes, which would send their prices even lower. It seems that cash is king right now, and it might remain so for quite some time. Dollar cost averaging into the high quality stocks during the market dips combined with reaping interest on money markets seems to be the best strategy under the current settings. If you enjoy those videos that help you make better investment decisions and you don't want to miss any of them in the future, consider subscribing to the channel.